Welcome to This Explainer. Today, we're unpacking a dream that, let's be honest, pretty much every single one of us shares: a secure, comfortable, and literally stress-free retirement. I mean, picture it for a second. Waking up, pouring your coffee, and just knowing your financial future is totally locked in. You've got the freedom to travel, relax, and basically never lose sleep over bills again. It's an absolutely beautiful vision, right? But actually making that a reality, well, that requires us to really master the mechanics of wealth. So ask yourself, will your retirement just happen by chance? Look, I get it. We all secretly cross our fingers for that one lucky break. A winning lottery ticket or some crazy unexpected windfall. But let's be real with ourselves for a minute. True financial security, it rarely just falls right into our laps. It demands consistent planning, disciplined saving, and most importantly, smart investing. Relying on luck is just a strategy designed to fail. It's time for us to take the wheel and take control. Okay, let's dive into this. Section 1, the retirement reality check. Because here is the harsh truth. Just leaving your money sitting alone in a traditional bank account, it's simply not going to be enough to achieve that dream. Which brings us to Section 2, beating the inflation trap. We urgently need to talk about the silent antagonist facing our money right this very second. You see, inflation is relentlessly working against your hard-earned money. Think about it. The cost of everyday essentials, housing, healthcare, groceries, getting around, it inevitably just marches upward year after year. And because of this, stationary money is actively losing its value. If you stash $10,000 away today, well, it's going to buy you significantly less a decade from now. It's just a fact. So let's look at the two main paths here. On one side, you've got the traditional bank account. Now, this feels safe, right? Because the balance doesn't really drop. But thanks to that inflation we just talked about, your actual purchasing power is just slowly melting away. But contrast that with the other side, investing. This is where your money actually rolls up its sleeves and goes to work for you. Instead of melting, it has the potential to grow, to actually outpace inflation and turn you from a passive saver into an active participant in the economy. And that brings us to Section 3, the compound interest engine. This right here is investing's ultimate wealth-building superpower. And this brilliantly illustrates the core mechanism of wealth creation. Compound interest is, simply put, when your investment earnings generate additional earnings over time. It's exactly like rolling a snowball down a hill. It starts out tiny, but as it gathers more snow, its mass and its speed grow exponentially. By making even small, consistent monthly investments over decades, you aren't just earning money on your original deposit. No, you're actually earning money on your money's money. It's a total game changer. So how exactly do we get that snowball rolling? Well, we use these vehicles for growth. And the best part? You absolutely do not need to be a Wall Street insider to use them. We're talking about buying shares of companies through stocks, lending money via bonds, investing in physical real estate, or using bundled options like mutual funds and ETFs. These are your engines. They plug you directly into broader economic growth, and they drive your compound interest forward. Moving right along to Section 4, diversifying to reduce risk. Because as that wealth grows, we absolutely need a solid defense strategy to protect it from market volatility and economic downturns. Now, what's really interesting about this breakdown is how simple, yet incredibly effective, true diversification actually is. Notice the 3 equal slices here. Spreading your investments out like this acts as your shield. By distributing your capital across different asset classes, diverse industries, like tech and healthcare, and entirely different geographic regions, you drastically reduce your overall risk. So if one sector happens to take a hit, the others step in to stabilize your portfolio and protect that growth. And having that stability built in is absolutely crucial, because successful investing requires a massive amount of patience and a long-term perspective. Look, the markets are going to experience volatility. That's just how it works. But history consistently shows us that disciplined investors win out in the end. Making emotional decisions like, say, panic selling at the absolute bottom of a dip out of sheer fear, that will completely undermine everything you've built. Consistency and solid financial education will beat emotional reactions every single time. Let's move to Section 5, why time is everything. We're going to see how this builds into the single most critical factor in this entire journey. So, the crucial point is right here when we compare the early investor to the one starting later. An investor who jumps in during their 20s or 30s has a massive built-in advantage, decades of time for that compound interest to work its magic. If you wait until later in life, you literally have to pour significantly more of your own cash into the system just to catch up to the exact same result.
Time is what does the heavy lifting for you. Mathematically speaking, taking action early always beats waiting around.
But hey, let's not forget, investing isn't just about old age or turning 65. A well-managed portfolio dramatically improves your quality of life today. It can create additional income streams, fund your kids' education, or even provide the capital you need to finally start that business. At the end of the day, it's about financial flexibility. Having that armor to weather unexpected storms means you can actually focus on enjoying your life, rather than stressing out over how you're going to pay for it.
There is a super famous saying that hits the nail right on the head. The best time to start investing was years ago. The second best time is today. It is so incredibly easy to look back and kick yourself wishing you'd started sooner. But regret doesn't build wealth, right? Action does. Every single dollar that you invest wisely today is a concrete step toward a safer, freer, and much more comfortable future.
Which brings us to a final, really important question for you to ponder. What will your dollar do today? Will it just sit quietly in a bank and surrender its power to inflation? Or are you going to put it to work, letting it build that financial foundation you absolutely deserve? The tools are out there, the strategy is totally proven, and time is of the essence. Take that next step, stay consistent, and take full control of your financial engine. Thanks so much for joining me for this explainer, and happy investing.